Welcome back, everyone. Let's dive right into this explainer. Today, we're taking that dense, honestly kind of intimidating maze of Chapter 17-V of the Income Tax Act, and we're going to transform it into a crystal-clear, actionable blueprint. Look, if you operate a business, manage payroll, or handle corporate finance here in India, you deal with TDS, tax deducted at source, literally every single day. But really understanding the overarching architecture behind it, that completely changes the game on how you manage your compliance.
Okay, so the absolute most crucial thing to remember right off the bat is that TDS is not an independent or final tax. Instead, it's strictly an advanced withholding mechanism. Think of it as the very engine that operationalizes the pay-as-you-earn economic principle. Basically, you, as the payer, are legally deputized to deduct a specific percentage from a payment before a single rupee ever hits the payee's bank account.
Now, you might be wondering, why on earth does this friction exist in the first place? Why does the government step in to take their cut before you even see the money? Well, it fundamentally boils down to macroeconomic stability and total transparency. By taxing the transaction at the exact moment of financial settlement, the government is creating an unalterable audit trail right at the source of the funds. It effectively bridges that temporal gap between when income actually accrues and when it's formally assessed later on.
So, here is our roadmap for today. First, the pay-as-you-earn engine. Second, decoding the tax architecture. Third, the TDS compliance lifecycle. Fourth, pitfalls, penalties, and precedents. And finally, number 5, Budget 2024, the new normal. Let's get into it.
Section 1. The Pay-as-you-earn engine.
All right, let's look at how the money eventually balances out. Under the constitutional authority of Entry 82 of the Union List, this massive daily operation is set into motion. But under Section 198 of the Act, whatever is deducted is actually deemed to be your income, meaning if the total tax withheld over the year exceeds your actual calculated tax liability, you aren't just out of luck. No way. You're legally entitled to a statutory refund from the government, complete with interest when you file your annual return.
This really illustrates the true genius of a system from a pure governance perspective. By delegating the heavy lifting of tax collection down to individual businesses and public entities, the government massively expands its compliance net across diverse economic sectors, all while severely cutting down its own administrative overhead. It's a win-win for the state. It guarantees them a continuous, non-cyclical stream of revenue, which means they don't have to rely nearly as heavily on short-term market borrowing just to keep the lights on.
Moving right along to Section 2, Decoding the Tax Architecture.
Now, we are looking at Chapter 17B, which, let's be honest, is an absolute beast of a legislative framework. It spans over 30 distinct operational sections. But to prevent cognitive overload here, we can just group these complex laws by economic activity. When you break it down like that, it's just categories. You've got employment, returns on capital on investments, commercial and technical engagements, real estate transactions, and the digital economy. Grouping it this way makes it so much easier to digest exactly who is supposed to pay what and when.
Let's look at some of the heavy hitters you probably deal with daily and exactly where those financial thresholds sit. Notice Section 194C for contractors, which triggers at a 30,000 rupees single payment or 100,000 aggregate, or Section 194J for professional and technical fees. Keeping these specific thresholds top of mind is basically the bedrock of your daily compliance.
Oh, and as a super strict anti-avoidance measure, do not forget that Section 206AA mandates a punishing minimum 20% withholding rate. Literally, if a payee simply fails to provide a valid permanent account number or PAN, you must withhold it a flat 20%. It's harsh, for sure, but it is a highly effective way to force everyone into the formal documented economy.
Section 3. The TDS compliance lifecycle.
Honestly, you should think of tax compliance as a predictable, 4-stroke engine. First step, as a deductor, you calculate and retain the percentage at the point of transaction. Second, you remit those funds through authorized banking channels using Challan ITNS 281. Third, you file your quarterly statements like Forms 24Q or 26Q. And fourth, you issue the formal TDS certificates, your Form 16 or 16A, so the payee can actually claim their credit. If any one of these 4 cylinders misfires, the whole system breaks down.
Go ahead and mark your calendars, because Section 200 strictly enforces these quarterly return deadlines for your filings. July 31st, October 31st, January 31st, and May 31st. You've got to hit these dates. Missing them isn't just a minor administrative oopsie, it's a statutory violation that automatically triggers financial penalties.
And this entire life cycle builds directly into the broader government infrastructure. Once you file those quarterly returns and they're processed by the centralized processing cell, the Traces portal automatically updates the tax credits in the Deductees Form 26AS and their annual information statement. It's a brilliant piece of tech that seamlessly connects the deductor's compliance directly to the deductee's tax return. It perfectly closes the loop and prevents any tax leakage.
Section 4. Pitfalls, penalties, and precedents.
Okay, so this is critical. You have to contrast a complete non-deduction with a short deduction. The legal consequences for your business are drastically different. A total failure to deduct or deposit triggers severe consequences, like Section 40A disallowances, which can invalidate a huge chunk of your business expenses. But a short deduction, say withholding under a bona fide but incorrect section, like deducting 2% instead of 10%, is treated very differently under the law.
And here's a massive sigh of relief for businesses courtesy of this landmark Calcutta High Court precedent in the CIT versus MS SK Techregal case. This ruling legally clarifies that Section 40AAI applies strictly to total failures, meaning if tax was withheld under a bona fide incorrect section, the expense cannot be disallowed. The Revenue Authority might ask for the difference and a little interest, sure, but they can't throw out your entire expense deduction over an honest mistake.
However, if you are simply late, the penalty framework is totally unforgiving. A delay in deduction, that costs you a compensatory interest of 1% per month. If you deducted it but delayed the remittance to the government, it jumps to 1.5% per month. And late return submissions, those carry a mandatory Section 234E late fee of 200 rupees per single day. These are compounding liabilities that will eat directly into your operating margins until you fix the failure.
Furthermore, there's the age-old headache of year-end accounting. As established by the ITAT Bangalore in the Volvo India case, ad hoc year-end accounting provisions that are recorded without identifying the counterparty do not trigger withholding obligations until a payee is actually identifiable. Basically, you can't be forced to withhold tax on a blind ad hoc year-end expense provision if you don't even know who the vendor is yet. No payee, no immediate TDS.
Let's wrap things up with Section 5, Budget 2024, the new normal. Let's analyze the massive rationalizations introduced in the Finance Act 2024. The whole legislative environment is shifting rapidly toward lower rates and broader bases. Take a look at this. In a huge win for small digital merchants who face tight liquidity constraints, the e-commerce withholding rate under Section 194.0 has absolutely plummeted. It went from 1% all the way down to just 0.1%. This is fantastic because it keeps the transaction-level audit trail perfectly intact, but it stops draining the cash flow of small online sellers. And this brilliantly illustrates the government's overarching policy shift for the year. Notice how historic rates for things like insurance commissions under 194D, individual property rents under 194IB, and general brokerage under 194H have all been slashed from 5% down to an amended 2%. The explicit goal here is to better match a payee's final tax liability up front. That effectively eliminates structural overwithholding and drastically reduces the massive volume of year-end refund claims the government has to process.
But they are definitely balancing the scales. Budget 2024 introduces a brand new 10% TDS on partnership firm payouts under Section 194T to broaden the base, but at the same time, under Section 192, they're allowing employees to offset their tax collected at source, or TCS, directly against their monthly salary TDS. That frees up some much-needed working capital for individuals who might have had TCS deducted on things like foreign remittances.
So, as the government continues to lower rates and aggressively digitize tax streams through Traces, how will your business modernize its compliance engine to keep pace? With the system becoming faster, smarter, and more seamlessly integrated every single day, I'll leave you with that provocative thought to consider for your own operations. Are you still relying on outdated manual processes, or are you truly ready for the digital future of direct tax? I hope this explainer brought you some total clarity today. Keep learning, keep optimizing, and we will see you in the next one.